Hello, my dear friends. My name is Rajesh Wadhwani and I am a civil engineer. I recently passed the IBBI Land and Building Valuation exam with 77.25 marks. At the request of my friends and colleagues, I have started this YouTube channel, Hari Seva IBBI Valuation Cracker, for land and building valuer to guide and support aspiring candidates across India in successfully passing the exam. Today we are starting cost approach. In cost approach, 7 marks MCQ are coming, plus 1 case study may came, up to 12 marks. So 7 plus 12, 19 marks is coming from cost approach. This cost approach divided in 4 sessions. In session 1, we will learn method of cost estimates for buildings, life of building, economic, physical, legal, factor affecting life of the buildings, total life, age, estimating future life, functional, technological, and economic obsolescence, reproduction cost, replacement cost, and type of depreciation. Let us start session 1. First, introduction to the cost approach. The cost approach is a property valuation method used to estimate the value of a property by separately valuing the land and buildings. This method particularly useful for property that do not generate income or unique in nature, such as temples, churches, museum, school, owner-occupied bungalows, and certain industrial properties. In cost approach, first land value is calculated, second building value is calculated, then land plus building value added, then total value will come. This is non-marketable properties. As we have learned earlier also, cost approach is suitable non-marketable properties such as temples, churches, museum, government buildings, owner-occupied bungalow, and certain industrial properties. Let us go. Key component of the cost approach. Land value. The value of the land is determined separately using the sales comparison method, where sale price of similar land in area are compared and adjusted to reflect the current market value of the land. First, land value will be calculated. Land value may be calculated by market approach, that is sales comparison method. Second, building value. The present day cost to rebuild the structure is calculated, that is the replacement cost. After determining the replacement cost of the building, depreciation is subtracted based on its age and condition, resulting in the depreciated replacement cost. First, whatever building is there, same square meter building present value will be calculated. From that present value, depreciation is deducted. What cost will come, that will call depreciated replacement cost. Third step, final property value. The total value of the property is arrived at by adding the land value and the depreciated cost of the building. Application of cost approach. Non-income generating or unique property where there is no income generation. In income approach, rental method and profit method, net present value and IR, all our income is generating from that income we are calculating the market value. In cost approach, land value calculated separate, building value calculated separate. And this is suitable for non-marketable property, such like temples, church, museum, school, other buildings that do not generate rental income and have no direct market comparables. This is also suitable for income tax purpose. The cost approach is often used to estimate the cost of construction and investment made in real estate for tax assessment, as is provide a clear breakdown of land and building value. Loan valuation. It is also used by banks and financial institutions to value the property for loan or mortgage assessment, particularly for owner-occupied bungalow and property under construction. Used in India. While the International Valuation Standards Council suggests that the cost approach is best suited for non-marketable property, it is still commonly used in India for marketable properties such as owner-occupied bungalow and factories. This practice may differ from international norms but remain widespread due to local valuation preference. The cost approach provides a detailed and systematic way to estimate property value, especially when other valuation method may not be suitable. Conclusion. The cost approach offers a systematic way to estimate property value, especially for unique or non-marketable property. However, its reliability is questioned when applied to marketable property, and it should be used with caution, especially when considering factors such as demand, supply, and income potentials. Now we will start. Type of estimation method for cost approach in construction valuation. In the field of property valuation, there are several methods used to estimate the cost of construction. Each method has its own approach depending on the purpose, type of property, and availability of data. Below are 5 key methods of estimating the cost of construction. First is book value method. This method relies on the historical cost of the property adjusted for depreciation. This formula is book value is equal to historical cost or original cost minus accumulated depreciation. It is commonly used for accounting purpose and provide a straightforward way to assess value based on recorded financial data. In book value, original cost or historical cost minus accumulated depreciation, we will get the book value. Flat rate method. The flat rate method uses a standard cost per unit area, such as carpet area, plinth area, to estimate total cost. The formula is total cost area into cost per square meter. Area multiply with cost per square meter, we will get the total cost of the construction. In plinth area and carpet area, one problem may be if building height may be differ. Sometimes building height 9 feet, 10 feet, 11 feet, 12 feet. So plinth area and carpet area will not give the correct cost. At that time, total cubic meter cost may be multiplied by area, we will get the cost. This method is quick and simplify the estimation process by applying a uniform rate across the entire area of the property. It is often used for preliminary estimate where detailed plans are not yet available. If detailed drawings and is not available, it is very difficult to calculate the quantity and other things. Then for preliminary, we can get the idea flat rate method, how many square meter multiplied by the plinth area rate or carpet rate, we will get the total cost of the project. Third is cost index method. This is very important method. Many times 12 number case studies coming, and one case study cost index method 99% is coming in IBBI, Land and Building Valuation exam. The cost index method adjusts construction cost over time and location using a cost index. This index accounts for inflation, regional variation, and market condition. Authority like the CPWD, Central Public Work Department, and the Income Tax Department often utilize this method to evaluate property value and assess tax. The formula used in this method: base cost, current cost index, and base year cost index. At per present, base cost is 2001. Current cost index, you will get the current cost index 2022-23. Divide by base year cost index of 2001, you will get the total cost. It helps maintain consistency in cost evolution by adopting older cost data. Fourth method, detailed quantity method, and we can say land and building method also. The detailed quantity method and the land and building method follow a similar approach involving precise measurement of material labor based on detailed project drawings. In this, total cost equal to sum of all the quantity of each element into market rate. First, as per project drawing, we calculated all the quantities, excavation, PCC, RCCs, shuttering, reinforcement, flooring, plaster, masonry, all the items, quantities calculated, and that will be multiplied by market rate or tender quoted rate or CPWD or PWD schedules. The detailed quantity method is recognized as one of the most accurate methods for construction estimation, and it is frequently used in valuation for court and official purpose. Court prefer this method, but this is very lengthy method to calculate quantities. In both methods, the total project cost is derived from adding up the individual quantity of building elements like foundation, walls, roofing, etc., applying market rate. This method ensures a reliable estimate when complete project designs are available. Fifth method. Fifth method is reinstatement method. The reinstatement method estimates the cost to replace or reinstate a property to its original condition. Consider current construction cost, material and labor, along with any enhancement made to the property. This method often used for insurance purpose and to assess damage for the claims. These five is most common methods used in cost approach. Also, some other method technique is there if sufficient data is not available. In addition to the main method, several other estimation techniques can be employed based on the project's needs. Preliminary estimate often used in the design and planning stage. This estimate provides a rough idea of project cost using method like unit rate and area base area. If you are having not drawing any planning, but you know the total approximate square meter of construction building 20,000 square meter, 25,000 square meter, then you will get the approximately preliminary estimate of the project. Element estimate. This estimate break down cost into individual components or element of the building, providing a detailed view of cost associated with each section. This divide in number of parts, say in building construction, cost of construction, separate cost, electrical cost, separate, HVAC system cost, separate, super finishing, yeah, special specification for tiles and other thing can be taken separate, and some of the cost that will call a element estimate cost method. Third, approximate quantities. This method involves grouping similar works item and measuring them to create a faster, less detailed estimate, which is useful earlier project stage. This method and technique offer flexibility in cost estimation, allowing quantity surveyors and project manager to select the most appropriate approach based on the stage of the project and the information available. Now, before learning depreciation and depreciation method, we have to learn some more definition. First, historic cost. Historic cost refer to the actual amount spent by owner for constructing a building, encompassing all costs related to labor, material, and associate service. It represents the first time acquisition cost of the property. The cost is significant for accounting purpose and reflect the financial investment made at the time of construction. Sometimes question is coming on historical cost and original cost. Let's first start original cost. Original cost is used to differentiate the cost incurred by the first owner from those to subsequent owners. While it includes the historical cost, it represents the price paid by the new owner when acquiring the property, which may include appreciation and depreciation over time. Let us understand both the difference with the example. For example, a flat cost rupee 20 lakhs in 2001 for the first owner and is sold for 40 lakhs 2024. Is sold for rupees 40 lakhs in 2024. What is the historical cost? What is the original cost? MCQ coming one number. The historical cost is rupee 20 lakhs. क्योंकि first time building is constructed, that time cost is called a historical cost. If after that some other owner is purchased the building, whatever cost he has purchased, that cost will call a original cost. While the original cost for the second owner is the 40 lakhs. Essentially, it is the depreciate replacement cost of the building for new owner and is often used in balance sheet for accounting purpose. If first company purchase flat, in his accounts book, historical cost will be 20 lakhs. If second company purchase same building, in his account of books, original cost will be 40 lakhs. Third, replacement value. Replacement value refer to estimate cost required to replace an asset with a new one that has similar kind, quality, and functionality. What is the replacement cost if building is constructed? To know the replacement cost, if same size of building and same quality and same function is constructed now, what is the at present cost? That is called a replacement cost. This value reflects the amount needed to purchase or construct an equivalent asset at current market price, at now price, at current market price, at present price. It is commonly used in insurance and property valuation to determine the cost to replace assets that have been damaged or lost. Importantly, replacement value does not take into account the original cost of the asset. Instead, it reflects the current cost of new asset with similar features. Replacement cost is not related with the original cost or historical cost. It reflects present cost of same quality and functionality in same area. What will be the present cost? That is called a replacement value. And reproduction cost. Reproduction cost is the estimate cost to produce an exact replica, mirror image of existing assets. This means the new asset must have same utility function specification as is original without considering advancement in technology or current trends. The main difference is replacement cost when we are constructing at present, we are considering same quality. However, we are taking new functionality. If I will tell an example, in old building, cement flooring is there, but in replacement cost, now it will be taken tile flooring. But in reproduction cost, it will be taken same type of flooring. This means the new asset must have same utility function specification as original without considering advancement in technology and current trends. Reproduction cost is particularly relevant in the cases involving heritage building or property with historical significance, where the exact specification and material of original asset are necessary for the replica. This both cost is also calculated for the insurance purpose. Let us first understand the difference between the replacement cost and reproduction cost. One number MCQ is coming in IPPI exam. Definition. This IO prepared this type of tables for comparison. You will not find this type of table and comparison in tabular forms. Cost to cost to replace an asset with a new one of similar kinds, quality, and functionality. Reproduction cost to produce an exact replica of existing assets. Focus and consideration. Reflect current market price for modern equivalent and ignore original cost. Emphasize identical specification characteristic of original asset without technological advancement. That is a reproduction. Application used for assessing cost to replace damage or loss asset commonly in insurance. Prevalent for heritage building where historical accuracy is critical. Common mistake. Often confused with reproduction cost by valuer. Mistaken for replacement cost leading the valuation inaccuracy. Also due to this common mistake, our 25% mark is deducted. 1 into 25 1.25 mark is loss. Please take care of this type of common mistakes. Do not confuse this type terminology, replacement value and reproduction cost. And further, we will also study depreciation and depreciate value. In the both the value, so many times confusion, and we are doing answer. Okay, now let us start life of building. The life of building is a critical factor in property valuation and management, comprising various aspects that determine its usability and economic viability over time. Here are the key points to consider. Physical lives. Physical life refer to the actual survival duration of the building before its collapse. Before collapse, whatever life of building, that is called a physical life. Assuming the property is structurally sound, its physical life can be extended almost 80 to 100 years and sometimes more than 100 years also. However, adverse factors such as poor workmanship, use of inferior materials, careless alteration, and excessive structural loading and poor maintenance can significantly diminish the lifespan. Functional life. Functional life pertain to how well a building continue to serve its original purpose amid social and technology changes. Over time, building may become less suitable for their intended use, necessitating adoption or repurposing. Structural changes may be required to accommodate new function, impacting the overall lifespan of the building. Third one is economic life. Economic life is the duration during which a building remains economically viable and continue generate a return on investment. This aspect compares the cost of maintaining the property against its potential replacement value. A well-maintained building typically aligns with its planned or income-yielding life. The economic life of RCC framed structure is generally considered to be 60 to 80 years, while for brick or stone masonry building it is estimated at 50 to 60 years. Sometime one mark MCQ question is coming on this life. If RCC frame structure, what will be the life? Then it is 60 to 80. If it is in MCQ brick or stone masonry, the life economic life is 50 to 60 years. Neglect the excessive wear and tear can reduce the economic life significantly. Life due to obsolescence. Obsolescence refer to decline in building value and usability due to societal changes, evolving lifestyle, or shift in the market demand. For instance, best example is older Charles, with shared toilet are becoming obsolete as modern preference shift towards self-contained units. In earlier in Bombay, 70 years before, 90 years before Charles system was there. In Charles, so many building will be there, tenant 50 to 100 tenant will be there, and there is a separate toilet system. From building you come to out and go to separate toilet. Now this system is not functionally acceptable to anyone. All one prefer toilet in his house. This is the best example. Similarly, traditional small shop may lost relevance due to rise of shopping malls in metropolitan area. Life due to legal constraint. Legal constraint can impose limit on the life of building, especially if constructed on leasehold land. If leasehold is of 30 years and building life is a 60 years, the unexpired period is taken as per lease terms and conditions, that is only 30 years. Example, if building is situated on leasehold land with only a 30 years lease, total life of building effectively capped at 30 years, irrespective of its physical and economic life which may exceed 60 years. Take care at the time of example, life due to legal constraint also. Now we will learn depreciation. Depreciation represents the reduction in value of asset over time due to various factors. The main type of depreciation include physical depreciation. Physical depreciation refer to the normal wear and tear of an asset due to uses over time. Factor influencing physical depreciation: manner of use of buildings, how the asset is utilized, affect its lifespan. Environment aspect: exposure to harsh environment condition can accelerate depreciation. Natural forces, weather and natural disaster contribute to deterioration. Accidental aspect, accidental damage can lead to additional depreciation. 1 mark MCQ coming on this. What type of depreciation? Sometimes he give the environment aspect, he will ask what type of depreciation. That is a physical depreciation. Remember, environment aspect, natural forces, accidental aspect, all are coming under physical depreciation. Economic obsolescence. Economic obsolescence occur when an asset is underutilized, failing to achieve optimum economical potential, or we can say HABU. A residential building in a commercial zone represent a missed opportunity for higher return. If commercial zone, a residential building is there, so he will miss the chances of getting the higher return. Legislative policy protecting slum area can lead to underutilization of property. High repair cost and dilapidation can make maintaining a structure uneconomical, leading to increased depreciation. 1 mark question is coming, dilapidation. He is asking which type of depreciation. It is economic obsolescence. Functional obsolescence. Functional obsolescence arises when an asset design and feature become outdated, no longer meeting current user needs. Example, old places converted into hotel to meet the current market demand. Old palaces, old buildings which are having height more than 15 feet, 16 feet, that old palaces are functional obsolescence. No one like to live in old places. However, it will convert it in hotel to meet a current market demand, current functional demand. Outdated residential building like Charles with common toilet become less desirable. Now, no one prefer to live in Charles. Rapid technological advancement can render newer machinery or computer obsolete within a few years. If you are buying a computer within 2 years, technology change, your a computer will obsolescence within a few years. Technological obsolescence. Technological obsolescence occur when advancement in technology render existing structure or equipment less desirable or outdated. Example, preference has shifted from load-bearing structure with thick walls to high-rise RCC frame buildings. Earlier, wall of construction thickness is 15 inch, 18 inch, 20 inch. Now we are using RCC wall that is 4 inch to 6 inches sufficient. So we are getting more carpet area. So this all the technological obsolescence. Also earlier all the doors and windows used by the timber. Now it has been replaced with the like steel or aluminum, driven by improvement in technology and construction method. This is the four type of depreciation. Now important method of depreciation. Today we will learn only method definition, understand what type of method. In next session, session 2, we will learn depreciation method with formula and numerical questions. Depreciation is the reduction in the value of asset over time. Reduction value of asset, that is called a depreciation. Depreciation method are used to calculate depreciation depending on type of asset, purpose and its requirement. The main goal is to estimate the decline in value based on either the original cost or historical cost or replacement cost. Below are some key methods. Direct appraisal method, that is also called lump sum depreciation. The valuer estimates depreciation based on physical inspection of the assets. The percentage of depreciation based on valuer experience and judgment. Without any specific calculation or reasoning, this method is useful for assets like machine or small structure where wear and tear are unpredictable. Second, observed depreciation method. Depreciation estimate by observing the asset current condition and considering factors like age, maintenance, and uses. In second method, valuer consider what is the age, maintenance, and uses. Written down value method, that is called also account method. This method reduces the asset value by a fixed percentage every year. It's commonly used by accountants for financial statement. Next, straight line method. Depreciation is calculated by spreading the asset cost evenly over its useful life. It preferred for machinery as the depreciation is uniform over time. Next is constant percentage method. This method applies a constant percentage each year to the asset's value, typically used by PWD engineers for infrastructures. Next, decline balance method. Similar to written down value method, but depreciation is applied on a reducing balance, meaning it decreases over time. Sinking fund method. Depreciation is calculated by considering an interest-based fund set aside annually to replace the asset after its useful life. This method is often used for buildings. Sum of the digit method. A decline rate of depreciation is calculated based on sum of asset useful years. That is sum of digit method. Statutory depreciation method. Depreciation is determined by legal or statutory requirement. Each method serves a specific purpose depending on whether the factor is own financial reporting, tax calculation, or market valuation. Yeah, today's session one is over.